Hi everyone, welcome to the weekly webinar. My name is Wayne McCurrie. I'm going to be the host of the presentation, and I'm going to run through a quick overview of the local and global economic and market scenario. Please, if you have any questions, stick it up on the Q&A and I'll try and address them at the end of the presentation. I'm going to talk about looking back, going forward, trying to have a look at what's happening and trying to make some interpretation of the current scenario that is unfolding before our eyes. And obviously it's a very, very difficult scenario. We've never really gone through anything like this before. And I suppose almost then by implication, it means what happens afterwards is going to be different to other recoveries that we've had from recessions. But let's go through the presentation. Now, the biggest single factor that's caused this recovery or this recession to be very, very different from previous recoveries is how quickly the stock market has recovered and what's happened to the economy. And I think this slide shows it all. The stock market itself, the facade of the building there, looks great. The stock market's hitting record highs, specifically overseas. We have seen a little bit of weakness in a few of the big tech shares, but I'll talk about that in a few slides' time. But the stock market overseas is at record highs. In South Africa, even though we're not at record highs, our market's only down very marginally from the beginning of the year. So, if someone went to the proverbial desert island on the 2nd of January and came back last week and just looked at the stock market, and they've had no contact at all with the outside world, they would say, oh, well, the market's okay. It hasn't done greatly, but it certainly hasn't done badly. Because, as we all know, and thank goodness, the stock market has recovered very, very strongly from the bottoms that we saw in March. We almost forget about this. The market was down about 40-odd%, but it has recovered. In South Africa, we have a couple of our sectors, mainly the banking shares, the retailers, and the property shares that haven't really recovered fully from the big bear market we saw in March. But our big international shares that are dual listed have recovered fully. Now, why has this happened? The stock market itself is influenced by two factors. The first one, and maybe even the biggest one, is interest rates. Interest rates have a huge effect on the valuation of the market. And then the second is profits. And the profits equals the economy. So profits have been decimated worldwide in most companies. The tech companies in America, their profits have actually probably been benefited by the slowdown, to be honest. But profits will be down worldwide this year by anything up to maybe 20-25%, and maybe even a little bit higher at 30 or 35% in South Africa. So the one pillar of the stock market, low interest rates, are phenomenal. Interest rates in America are zero, long-term and short-term. And long-term rates are about 0.5, 0.6%, which is effectively zero. In South Africa, we've had interest rates fall by 3% and maybe another small cut before the end of the year. And these low interest rates are just totally and utterly overwhelming what the economy is actually happening. Now, this worried us tremendously. The stock market just recovered too quickly, and we were expecting some sort of pullback, and maybe we still will see a relatively small pullback. But whenever we've been talking, we've always said maybe 10, maybe 15% pullback. It could still happen, but that's it. In other words, we don't for a moment anticipate a major downfall in the stock market, almost irrespective of what the economy does. Now, just to talk about the economy, well, first of all, let's go to bond rates. You can see their bond rates in America are 0.7%. And you can see how they've fallen dramatically at the start of the pandemic and how they've actually stayed there. So if you're a US investor, do you want to put your money into the long bond market and earn 0.7, or do you want to put your money on call, which is the slide I'm showing now, and earn 0.1%? You're going to buy the stock market, and that's why low interest rates are very, very supportive of the stock market. Now, globally, there's no inflation. I mean, even in South Africa, inflation is very subdued, even though we're starting to see a little bit of inflation coming through, and that will probably continue. But because inflation is so subdued, we are highly unlikely to see an interest rate increase globally for maybe even up to 2 years, and certainly in South Africa for the next year, we won't see an interest rate increase. It may go up in 2 years' time in South Africa because we have, we've got a few more problems in our economy than what we see overseas. But certainly for the foreseeable future, interest rates are going to stay low. And as I've emphasized so far in the presentation, that's very supportive of the stock market. Global inflation, there's the slide, I've spoken about it. It has ticked up a little bit from the bottom that we saw during the actual worst of the crisis, but it's still incredibly low. Now, what has the effect been on stock markets? I've already discussed that. These are the main American markets and the global market. And you can just see they all fell off more or less the same, and they've all recovered. And the red line, the NASDAQ, has had the strongest recovery of all. As you can see on the far right-hand side, the market has fallen off a little bit. I mean, nothing goes up or down in a straight line. And maybe we'll get a little bit more weakness there, but it's not going to be pronounced weakness in our view. So stock market, as I've explained, really, really supported by the low interest rates. This just shows you the slightly shorter term. So it's the same chart, just showing you shorter term what's actually happened since, I suppose, about 3 weeks ago to the US markets. It's still massively value over growth. Now, what that means is the companies that anticipate future big growth in their earnings, in other words, the tech companies, have done better than, let's call it, the banks and the retailers, etc. So the white line shows the tech companies, same picture as what I've shown you before in the NASDAQ, and the bottom orange line shows the so-called value companies, which essentially boils down to the banks and the retailers and general other consumer shares. They have recovered, but you can also see they have not recovered as much as what the white line, the tech companies, has recovered. Now, that's exactly the same as what we have in South Africa. So if you look at this in the context of the South African share market, the white line is Prosus and Naspers, and the orange line are the banks and the retailers. And this chart just confirms all of that. You can see technology shares up massively, and at the bottom, consumer services, financials, and energy are still lagging quite significantly in comparison to the technology shares. Right, we've got the election coming up, 1 month's time to go. The outcome, by the way, is not going to have that massive an effect on the market. Initially, there may be a big effect. The market might bounce up if one of the candidates wins, or it might fall if the other candidate wins. But that's relatively short term. Neither candidate is going to have a massive long-term effect on the financial markets. President Trump, if he's re-elected, may have a neutral to mildly positive effect because probably his tax cuts will stay in place. If Biden wins the presidency, it might have a neutral to slightly negative because he is going to tax more. But he may even put more stimulus into the economy post his election than what President Trump might do. So by and large, they balance each other out. But understand, in the interim, until the election, the next 30 days, you're going to see volatility. Any politician, foremost in their mind, is what can they do to increase their chances of being re-elected. And President Trump seems to be behind in the polls, but remember, these are polls. They can change, and they can change quickly, but he seems to be behind in the polls, and do not be surprised if he tries to do something to increase his chances of being re-elected. And we've seen good examples of this, quite a few of them in fact, but the most recent is that he called off any talk with the Democrats of putting a new, $2 trillion stimulus package into the economy. He called it off. Then all of a sudden, 2 or 3 hours later, he almost reverses that decision and says, I'm still going to give you stimulus. I'm just not going to do it in conjunction with the Congress, in other words, the Democrats. I'll just do it myself, and I'll send you the $1,200 check, and I'll support the airlines. So he backtracked, saying no stimulus until after the election, saying I will do it, but I'll just do it myself and not involve Congress with that. And I think we're going to get a few more examples of this until the election happens on the 3rd of November. Right, turning to South Africa now, you can see our All Share Index has recovered. Look on the right-hand side of the chart. It's not back at all-time highs that we saw under Ramaphosa, in 2017, beginning of 2018. But our share market's been a very, very difficult share market to invest in. I mean, it's done nothing for 5 years. It moved sideways for 3 years, up on Ramaphosa. Then maybe just before the virus, it maybe fell on Rama Reality, and it's recovered. But it's been a very, very difficult place to invest. And essentially, it's been driven by the big dual listeds, especially Naspers and Prosus, the platinum shares and the mining shares in the more recent past, and the true laggers are the banks, the retailers, and the property shares. So it's been difficult to actually invest in this market because of the vastly different performance and at different times of the various sectors. Just turning to the Rand, I mean, people want to talk about the Rand all the time. And you must remember a few, reality checks about the Rand and what the Rand actually represents. The Rand represents South Africa, and it's not a good scenario. I'm not saying it's catastrophic yet, but it's not a good scenario. And what that implies is that the Rand will more than likely, over long time periods, depreciate by around, let's call it 5% a year. So over long time periods, the Rand, you can almost bank on it, will depreciate by roughly 5% a year. But that's on a 10-year plus basis. In the interim, the second major characteristic of the Rand is it's incredibly volatile. So the Rand, in my view, probably only spends maybe as little as 20 or 25% of its time correctly valued. And that's what this chart tries to show. So the blue line and the green line, that little tram line across the graph, tries to represent some sort of fair value band. And the red line is the Rand. And as you can see there, the Rand spends very little time within that fair value trading range. So remember, whenever you look at the Rand, 75% of the time it's at the wrong value. Only 25% of the time is the Rand more or less correctly valued. Now, we're quite lucky the Rand has recovered from the big sell-off because of the virus, and now at 1630, 1640, 1660, it's more or less fair value. It can strengthen. In fact, our house economic view is that the Rand will strengthen to the middle of that range, about 15.50 Rand by the end of next year. It's maybe incorrect to say the Rand's going to strengthen. Our actual underlying view is the dollar's going to weaken. When the dollar's had a rampant 10-year bull market, and that can't continue forever. They've got massive debt within the government, and that we think is going to actually weigh negatively on the dollar. But that doesn't really matter. The Rand now is trading at more or less fair value. So if you want to take money overseas, now's not a bad time to do it, even though we think it may strengthen a little bit going forward. But I mean, that's just our forecast. But at least it's not at 19 or 20 when you know it's undervalued. And you can't even believe it. You know, the Rand was down at 12 in 2018. That was too expensive. So in other words, whenever the red line falls below the green line, the Rand's expensive. And if it goes above the blue line, the Rand's actually cheap. But at least now, the Rand is trading more or less at fair value, and you can make an investment decision based on those parameters. Right. How long until the world recovers? Now, this chart shows various scenarios. This is the global scenario, but it's exactly the same for South Africa. So when you look at the blue line, the top line, that's what the estimates were for the global economy going forward, before the virus. Then obviously the red line shows the big fall off in the virus. In other words, the global economy is going to shrink or has shrunk by about 10%. Then you get the two scenarios. We have recovered a little bit, so that's the red line going up. And this recovery, surprisingly enough, is a little bit stronger than what people anticipate worldwide. South Africa, we don't know yet because we haven't seen the data. But globally, both the Federal Reserve Bank in America and the International Monetary Fund / World Bank have said that so far the recovery is actually a little bit quicker than what they initially anticipated. So even though the global economy is still 5 or 6% smaller because of the virus, the recovery is actually turning out to be a little bit stronger than what was initially anticipated. Now the big risk is that second part of the red line, that one that gives you the double dip. Will the world slow down again because governments go back to level 5? Just to put it in terms that we understand in South Africa. What are the chances of massive restrictions being put on the world's economy again because of the virus? I don't think that's actually plausible. What we have found out and what the world has found out is there's significant economic impact of the lockdowns. Now, it's not just an economic impact, it's a social impact, it's a human cost. I'll talk about South Africa in the next few slides. But I mean, we lost 2.2 million jobs out of about 13 million that we have in the country. I mean, our unemployment, depending on how you measure it, but if you take the worst measurement, it's 50%. And youth unemployment is probably getting closer to 65 or 70%. So even though the virus itself obviously has a human impact, the lockdown, the economic effects of the lockdown also has a human impact. And that human impact was massive. So I doubt very much whether the world, South Africa, almost irrespective of what happens to the virus, infection rates, etc., I doubt in the extreme that we will go back to a full shutdown like we had in level 5. There may be other restrictions placed on travel. There may be other restrictions placed on a few things, but a total shutdown of the economy, I don't think is going to happen. So I don't think the double dip scenario is actually on the cards. If it isn't, then we are going to have to the world will take at least 2 years to recover to the way we were in 2019. And South Africa, unfortunately, may even take a little bit longer. Right, so let's talk specifically about South Africa. And here I'm using the finance minister's own slides. Now, he's going to present these again, or he's going to revise these again when he presents in literally a couple of weeks' time when he does the medium-term budget. And this medium-term budget will probably be the most important political statement made by the ANC since they became the government. Now, and I really mean that. This is going to be the most important political statement made by the government. Now, it can go two ways. They can either do the right thing, or they can carry on the way that they have for the last 10 years. But there will be a clear statement made. And a lot depends on what the finance minister actually says in the medium-term budget. Because if you look at the left-hand chart, expenses in red are going up, and the revenue in blue is going down. And then you have those Hippo jaws, as the finance minister calls it. He says, the Hippo is eating our children's inheritance. Now, this cannot continue. Now, up until now, let's just put President Zuma, put all previous ANC presidents, their personalities and their characteristics aside for a moment. Up until now, our government's finances, our country's finances, were not in a precarious situation. They were actually fantastic from 2002 till about 2008. Our companies did well, our country did well. In fact, we did so well, we ran out of electricity. But we had phenomenal boom years. Housing market went up, share market went up, rand strengthened enormously. So those were fantastic let's call it a decade. And then, of course, we've had the Zuma decade since then. But as I said, put who was in charge aside for a moment. Up until today, our country's finances were not in a terrible situation. They might have been deteriorating, but they were never in a crisis situation. However, where we are now is clearly a crisis situation. So let me define crisis. Crisis doesn't mean we're going to collapse tomorrow. Doesn't mean we're going to go begging for international money and deferring of debt and defaulting on debt tomorrow. But what the crisis does mean is that if we don't do something within the next, I don't know, let's call it 3 to 4 years, then unfortunately we will truly end up in a catastrophic situation. In other words, if the government doesn't do things differently, starting now and for the next 3 to 5 years, unfortunately, we will really end up as, you could argue, a failed state. So we are at a true inflection point now where the government has got to start doing the right things. Now, the right things are many, and we all know what they are, but essentially they can be summarized in one way, in one viewpoint or one sentence. They've got to govern the country properly. In other words, they've got to do the proper thing when it comes to law and order. They've got to do the proper thing when it comes to corruption. They've got to sort out the state-owned enterprises. Up until now, they've never been under massive pressure to actually do the right thing. Whereas now the pressure is actually unbearable and has catastrophic consequences if they don't do it. But I want to emphasize, it's not going to happen. This catastrophe is not going to happen tomorrow. We don't have to panic about it now. I am extremely confident that the government has started to do the right things and will continue to do the right things. Because quite frankly, there's no other option. There's no other way out. You can't carry on the way they were. You can see the hippo eating our children's inheritance quote there. So when you look at the right-hand chart, it's the same picture, just expressed slightly differently. The dotted red line is what government debt will do if nothing is done. If we carry on the way we were, that's what government debt will do. It will get to an unsustainable level where we will in 10 years' time be, or 8 years' time, whatever, be a failed state. However, the second scenario in the dotted grey lines gives you the finance minister's own projections of our debt if they do the right thing. So I've given those two scenarios. Just look at those debt levels. They're currently 80%. The good scenario says 87 in 2 years' time. The bad scenario says 106% in 2 years' time. We forget all of this. In 2008, our government debt to GDP was 24%. So it has gone up. Well, on the bad scenario, it would have gone up threefold. On the good scenario, gone up 3 times. The bad scenario 4 times, and the good scenario 3 times. So, the government has got to actually correct all of this. Now, what does all of this imply? It implies we hope and we sincerely trust that the new ANC administration will reverse the previous 10 years' deterioration, but it also unfortunately means got to tax more, got to find money somewhere. So whether that's VAT, I doubt it, whether it's donations tax or estate duty tax or capital gains tax, it could very easily be. I mean, they've got a huge deficit that they've got to fill, and they cannot just fill it by cutting expenditure. There's got to be more revenue coming in. And for the moment, they've put aside prescribed assets, but that could still happen. The government needs money to try and sort this problem out. And we'll find out more about that in a few weeks' time when the minister talks. Right. We are confident the world and South Africa will recover. The question now is when. I've already spoken about this. We are recovering. The world is getting better. The recovery may even be slightly stronger than what was initially anticipated. I'll just give one example of this. I'll use Capitec Bank as this particular example. When they came out with their results, which weren't all that bad. They said, our profit is down. I mean, they know that the profit was down, I think 70 or 80%, which in this environment, just to make a profit is actually not bad at all. But the profits were down massively. And they're fully capitalized, like all of our big banks. They're fully capitalized. But they said quite clearly, the SA Reserve Bank has instructed us not to pay a dividend. And even though we made a profit, it was smaller, but they still made a profit, and we fully capitalized, we are sticking to the Reserve Bank's guidance not to pay a dividend. But just as telling, and part of the story that I'm explaining now, is they also said the Reserve Bank took this decision right at the beginning of the economic lockdown, it's level 5 lockdown, because at the time, they didn't know what the consequences would have been, the economic consequences would have been for the lockdown. So in other words, what they said was, the Reserve Bank at the time looked at the facts. No one knew what was happening. I mean, we've never experienced before. No one knew what the outcome would be. And based on that scenario, the Reserve Bank told all the banks no dividends. But by implication, they said that, Capitec said that if the Reserve Bank had to make the same decision today, because now you know how bad it was, and it was bad, I mean, we all know this. Our economy shrunk by 16, 17%, 2.2 million jobs lost, etc., etc. However, they did say by implication that if the Reserve Bank had to make that same decision again today, given what we know and the extent of the recovery, it was unlikely that they'd say, pay no dividends, and they keep your dividends back. So in other words, no one knew how bad it would be, and no one knew how quickly we would recover at the start of level 5. Now we know how bad it was, and we also know the recovery is happening. I mean, the recovery is clearly happening. When you look at Spur, now Spur is a classic example of consumer South Africa. They issued their results literally maybe an hour ago, and they said the following. Their restaurants are about 92% open. They're trading. They are trading at about, so the number of restaurants, 92% of the restaurants are open. The volume that they're getting through is about 88% of what they had before the lockdown. So if you compare to what happened before the lockdown, they're at 88% sales volume. I mean, their profits haven't recovered all that much yet because they've had to incur additional expenses. Now, during the lockdown, I mean, it was virtually nil. Then during the takeaway phase, it was up at about 20% of normal turnover. But certainly now in September, they're up at 88%. In August, they were about 65%, if I remember correctly. So if you use Spur's results as an indication of the recovery, they're not fully recovered yet, but they're almost at 90% of what they were pre the full lockdown. And it's also quite interesting, just as a side comment, which ones have been popular. The steak has been popular, so Hussar's Grill has been very popular. The main Spur brand, a little bit behind Hussar's, but still popular. Rockamama's did extremely well. I mean, Rockamama's is virtually firing on all cylinders now. It's virtually not even down on what it was pre-COVID. But the ones that suffered, which I find interesting, is pasta, pizza, and seafood. They are still actually quite well below the level of turnover that what they were before the lockdown. So we are recovering. The recovery is on its way, but the full recovery will probably take at least 2 years. And as a parting slide then, before I go to any questions, keep calm and wash your hands. Now, this sounds funny, and it has been put in there to give a bit of a smile, but there's a very important lesson for every investor to learn in this slide. The worst thing you can do is panic in investments. That if you want to do true long-term damage to your portfolio, then you must panic. Now, there's two kinds of panics. It's a panic we've seen this year, where the economy, the stock market, the economy collapses, and everyone just wants cash. Sell. Just sell. The world is coming to an end. Now, it's wonderful if you can see that before it happens and you sell. But that doesn't occur all that frequently. But people panic. We're all human. And people panic dramatically when there's a 40% fall in the stock market. And they want to sell. They want to get out. And we also panic with the rand. In March when the rand went to 18, 19, everyone was saying it's going to 21, 22 against the dollar. And they panicked and they took money overseas. Okay, it hasn't fully recovered, but it's 1650, 1616. But there's another panic. Some people panic in because they feel they're missing out. So there, the classic example is Bitcoin. Bitcoin started at nothing. It went up and up and up and up and up and up and up. Wonderful. And it got to $20,000 per Bitcoin. And people were panicking in because they felt they were missing out. The next stop was 6,000. It's up at about 10 or 11,000 now. In investments, keep calm and diversify your portfolio. You always hear stories about people who made a killing buying a company or buying something that made a killing. Now you just hear about gold. Gold's done extremely well over the last, year and a half, 2 years. Prior to that, it was terrible. In investments, don't panic, either in or out, and also have a diversified portfolio. And thank you everyone for attending this webinar. We have got a question. The question is, in your view, was the lockdown the right move from an economic perspective, or could we have withstood the virus without the strict lockdown? Well, that's the million, not even a R1 million question, it's $1 million question. That is even $1 billion question. Unfortunately, we just won't know because lockdown happened, so we've got nothing to evaluate it against. In other words, we don't know what would have happened if there were no lockdown. We don't know how many people would have been infected. We don't know how overwhelmed the health system would have been. We don't know how many people would have died or how many extra people would have died if we had no lockdown versus the lockdown. So you just simply don't know the answer to that question. What we do know is the economic cost was devastating. We also in South Africa are relatively lucky for whatever reasons. Maybe it's just we have in general a far more youthful population than most of the world. Our death rates have actually been quite low compared to the global average, and that's a fantastic thing. What our total deaths will end up being, I don't know if it's 20 or 25 or 30,000. It's certainly highly unlikely to be the 60 or more odd thousand that was forecasted at the beginning of the lockdown. But as I said in the presentation, it's highly unlikely we'll go back to any sort of major lockdown, simply because the economic cost and, of course, the social cost of the economic cost has truly been devastating. But I've also thought about that for a long time. Could you have done it differently? Could you have preserved more jobs? Because I understand the lockdown just stopped the transmission rate. It didn't mean less people will get infected. It just stopped the infection rate. But you don't know what would have happened if there was no lockdown and the peak happened much quicker and at a much higher level of infection. What that would have done to the health system, and how many people have survived because they could get medical attention because the health system wasn't overwhelmed. Okay, next question. If you had 5 million cash, surplus funds, to invest for the next 5 to 7 years, where would you invest it, and what would your asset allocation be, both local and offshore? Okay, 5 to 7 years, reasonably long time period, and I assume these are surplus funds. So these are outside of your retirement funds. In other words, this money you don't need to live on. Okay, so I'm not going to advocate that you go gambling with this money. What I mean by that is that this 5 million rand does not have to be a well-diversified, balanced portfolio that's matched to your risk profile. So I'm treating this question that the 5 million rand is really surplus funds. So in other words, where do I think the best returns are? You going to get the best returns over the next 5 to 7 years? South African bonds are extremely good investments. You get between 9 and 10% yield in a 3.5% inflationary environment. That's an extremely good yield. And if we write on our rand, the rand should be relatively stable over certainly the next 3 years, but maybe even a little bit longer. So I would put some money into the SA bonds. There's a massive amount of risk that's already priced into our bond market. Secondly, if you make the assumption that our economy will recover, SA banking shares and SA retailers are properly cheap. I mean, they on a 5 to 7 year basis, these are seriously cheap assets. I'm not saying they can't fall. First, they can't fall initially, and they can't fall anymore. But on a 5 to 7 year basis, they're cheap. And then finally, you've got to take money overseas at the current rand, or part of that money overseas at the current rand exchange rate. I would maybe be a little bit cautious to buy shares overseas. There's clearly there's more overvaluation in the US share market than our share market. But I would take money overseas and maybe park it a little bit there in cash. The rand's at fair value now. I know we think it's going to strengthen, but that's just a forecast. We don't know what's going to happen to the rand. So to answer the question, I would put 1/3 in SA bonds, I would put 1/3 in SA banking and retailer shares. I'll take 1/3 of that overseas, but I'll only invest maybe half of it now in the share market and keep the other half in case you start to see a little bit of weakness. But I want to come back to my initial part of this answer. This is surplus funds. If I would give a very different answer, if people said to me, this is your retirement money, how would you invest it? Okay, second wave, who knows? I mean, quite frankly, who knows on the second wave on the virus? Clearly, the infection rate has picked up because we're out of lockdown. People have learned lessons, irrespective of legislation or not now. People have learned lessons. You wear a mask. You wash your hands. You cautious. You just cautious. So I doubt if we will ever go back, or we will have any second wave that even vaguely approaches the infection rates that could have happened had we not had lockdown. So people have learned their lessons. But the rates will go up as the economy opens up. There's no question that will happen. However, it will be a relatively subdued second wave. I mean, the virus is related to the flu virus, and flu does better in winter because it's just a better environment. So into summer, the infection rate and transmission rate naturally will decrease. But until there's a vaccine, this virus is with us. We might be able to control the transmission rates, but the virus is still with us till we get a vaccine. There will be a vaccine. There's also no question about that at all. Some American health official, I forget now, said yesterday that the vaccine will more than likely be out before the end of the year, and it will more than likely be distributed to the overwhelming majority of the world's populations by the end of 2021. The world pharmaceutical industry is going to gear up to produce this vaccine in unprecedented billions of doses in a relatively short time. So I suppose optimistically, the virus is with us until the middle of next year, and maybe pessimistically, it's with us until the middle of 2022. So we're going to have to live with infection. But as I said many times now, I doubt very much whether we are going to get a big second lockdown. Okay. Another question here. Considering the upside risks to the SA government finances and how that may affect inflation as well as the South African rand, is it opportune to go overweight global shares? Okay, there's two questions here. Is it the right time to go overweight global shares? To me, the answer is no. These are expensive markets. So I would be neutral to slightly underweight global shares now. If we do get some more weakness, if the market does fall a little bit, then possibly overweight. But I don't think now is the time to be overweight or massively overweight global shares. there's an element there. That recovery has been massive. And I've spoken about that a couple of times. So I don't think it's right to be overweight global shares. Now, on the rand, I mean, we know the outcomes for South Africa. It's either the high road or the low road. And we've heard high road and low road our whole lives. I mean, we've always heard the high road scenario and the low road scenario for, I mean, I've probably heard it for 25 years. But this time it's a bit different because now you're forced to choose. Prior to this, the government wasn't forced to choose the high road or the low road. So if you think the low road will happen, you know the outcome, same as me, the rand will depreciate significantly. If you think the high road happens, then the rand could strengthen quite a bit. But to answer the question, the rand is at fair value now. If you want to take money overseas, now is not a bad time to do it. Right, as far as I can see, those are all the questions. Oh, yeah, we go. One more. You stated the SA Bank and retail shares undervalued at the current time on a long-term basis. Property shares. Very good question, Edward. However, However, property shares, quick scenario, property shares are in the eye of the storm. They're in the eye of this virus. There is no doubt whatsoever that how property is used, either retail or office. Industrial is very different, but retail and office, which is by far the biggest component, have been truly affected by the virus, and it's a permanent effect. It's maybe not as harsh as what people think it's going to be. I mean, we all will eventually go back to the office because we'll go crazy sitting at home. And you cannot function as an organization online forever. You've got to actually meet people and know them and get to see them. So we will all go back to the office in some format at some stage. But it will probably be less than what we used to. So maybe it'll be 1 week at home, maybe 1 day at home per week, or maybe 2 days at home per week. Retail was already changing before the virus. So what the virus has done is accelerate the online trend. So property shares have been materially and permanently affected by this virus. So they should be weak, and they are weak. But now the question is, are the shares too weak? Have the shares fallen too much? To try and summarize that very quickly, if property was worth 100 before the virus, it's now worth 80. So 20% of property values have probably been destroyed permanently. Permanent is a long time. Forever is a long time. But let's just say 20% of property share values have been destroyed. The problem is the share prices have fallen 50%. So no matter how negative a scenario you paint for property shares, the shares themselves have probably fallen more than that worst case scenario. And a classic example yesterday, Sogo Sun, they run big casinos. Almost all of their properties are held by a company called Hospitality Property Fund. And Sogo is buying out Hospitality Property Fund because the price to Sogo Sun of buying the shares is less than the cost of paying them the leases. So in other words, let's just say, and I'm using examples now, let's just say Sogo was going to pay Hospitality Fund 50 million rand in leases in the next 3 years. Excuse me. Oh, my apologies. So let's just say Sogo was going to pay Hospitality Fund 50 million in the next 3 years. They could buy the company for 20 million. It's way cheaper to buy the company because they are so undervalued. But how long it takes to recover, I don't know. On the 5, 7, 10-year basis, I think you'll make quite a nice amount of money. But I don't know when you're going to make it in those 5 or 10 years. And I also don't know if the share prices are going to fall another 15 or 20% before they turn. But to answer the question, yes, property shares are seriously cheap on a 5, 10-year basis. But it's riskier. These shares could fall quite a bit more before they recover. Right, I think that's all the questions. Once again, thank you everyone for coming along and hopefully have got some insights. I mean, whenever someone like me talks, you understand I don't know the future. No one knows the future, no matter how authoritative many people seem when they talk. about the future. No one actually knows the future. If I'm right, the worst is over. We are on a recovery path. The government will be either voluntarily or involuntarily forced to run the country better. So, the future from this level actually looks relatively good. So once again, thanks everyone for coming.